Welcome to Tesla Daily News Podcast for Thursday, January 15th, 2026. Today, we're tracking a mix of demand signals, product changes, factory strategy, and legal overhangs that could all influence Tesla's margins and valuation narrative. Let's get into the biggest Tesla-moving stories. Story 1. Tesla's US EV market share is rising again, and that matters more now that incentives are gone. Here's the hook. Tesla appears to be regaining US dominance as competitors stumble in a post-incentive market. Context. When federal EV incentives disappear, demand becomes more sensitive to price, manufacturing scale, and charging convenience. Tesla's core advantage has always been cost structure, supply chain integration, and an installed charging network. Details. Business Insider reports that Tesla's US EV market share has soared as rivals struggle without government help. The key investor angle is that Tesla can keep volume moving at lower price points better than most legacy automakers because Tesla's fixed costs are spread across higher volume and its platform is more standardized. Impact. If Tesla is taking share while the overall market is under pressure, that's a classic setup for stronger pricing power later and potentially better factory utilization. Utilization is a margin story. Higher utilization helps gross margin even if sticker prices stay competitive. Takeaway. Watch for whether this share gain shows up in quarterly US delivery mix and whether it reduces the need for aggressive incentives and financing deals. Share gains are only bullish if Tesla can hold margin while doing it. Story 2. EV incentives hit record highs in December, even as prices edge down. Hook. The EV market is leaning heavily on discounts and incentives, and Tesla investors should treat that as both a demand signal and a margin warning. Context. Even if Tesla doesn't need to discount as aggressively as peers, the industry's incentive environment affects the competitive set. When everyone else throws cash on the hood, Tesla must decide whether to match, differentiate via software and charging, or accept slower growth. Details. Kelley Blue Book data covered by Electrek says EV prices ticked down in December while incentives surged to record highs. That combination helped drive the strongest monthly EV sales since federal incentives were removed. Impact. For Tesla, this is a two-sided setup. Stronger category demand supports volume, but incentive-driven demand is typically lower quality and can fade fast if discounts get pulled. Investors should expect continued price competition, which caps near-term automotive gross margin upside. Takeaway. Watch Tesla's reported average selling price trend and whether Tesla shifts more emphasis to software take rate, like full self-driving subscriptions, to offset hardware margin pressure. Story 3. Top-selling EVs in the US show Tesla still leads, but competition is getting sharper. Hook. Tesla remains at the top in the US, yet the podium is getting crowded and the fight is moving into the mid-price sweet spot. Context. In the US, the Model Y and Model 3 are the volume and margin backbone. Anything that threatens those positions can ripple through revenue, factory utilization, and future guidance. Details. Electrek reports that more than 1.27 million electric vehicles were sold in the US in 2025 and highlights the top 10 best-selling EVs. The Chevy Equinox EV is called out as a major hit, sitting behind the Model Y and Model 3. Impact. The implication is simple. Tesla's leadership remains intact, but General Motors and others are proving they can scale specific models when the value proposition is right. That pressures Tesla to keep refreshing features, improving cost, and holding a clean, simple ordering experience. Takeaway. The big investor question isn't whether Tesla is number one today. It's whether Tesla can keep the Model Y and Model 3 fresh enough to avoid a margin-killing price war, especially as competitors refine their supply chains. Story 4. Tesla updates the Model Y for 2026 in the US, including the return of the 7-seat option. Hook. Tesla is leaning into practical demand with a family-friendly configuration, and it's a small product change with potentially meaningful mix implications. Context. Tesla has been battling the perception that newer rivals offer more body styles and better cabin flexibility. Bringing back a 7-seat option targets families who might otherwise cross-shop larger SUVs. Details. Frandroid and other outlets report the Model Y 7-seat configuration returns in the US on the 2026 update. Another report says it's tied to the premium all-wheel drive configuration and costs about $2,500 more. Impact. If Tesla can upsell buyers into a higher trim and add a paid seating option, that's the mix and margin tailwind. Even modest mix improvement matters when overall pricing is under pressure. Takeaway. Watch whether Tesla expands this 7-seat configuration beyond the US and whether delivery times suggest real demand rather than just a configurator refresh. Story 5. Cybertruck demand and production utilization look weak relative to early targets. Hook. Cybertruck is underperforming versus the hype, and the market cares because it affects confidence in Tesla's product execution narrative. Context: the original Cybertruck story was not just a truck. It was supposed to be a proof point for manufacturing innovation, new materials, and a halo product that broadened Tesla's customer base. Details: Business Insider cites Cox Automotive data suggesting Tesla sold just over 20,000 Cybertrucks in 2025, far below Elon Musk's earlier stated ambition of 250,000 per year. Electrek goes further, claiming production is running at roughly 10% of planned capacity. Impact: underutilization is expensive. If a dedicated production line is running at a fraction of plan, unit costs rise and margins shrink. It also raises questions about how quickly Tesla can pivot capacity toward other products and whether demand limitations are due to price, design constraints, or practical usability. Takeaway: investors should watch for signs of a Cybertruck pricing reset, a simplified trim strategy, or a production line reconfiguration that improves utilization. The stock reacts less to the truck itself and more to what it signals about Tesla's ability to launch new platforms at scale. Story 6. Tesla grants a massive stock option package to a key executive, Tom Zhu. Hook: Tesla is paying up to retain leadership bench strength, and that's a governance and execution signal investors should not ignore. Context: Tesla has long been viewed as highly dependent on Elon Musk. Any move that highlights operational leadership, especially in manufacturing and delivery execution, can reduce perceived key person risk. Details: Electrek reports Tesla granted Tom Zhu, Senior Vice President of Automotive, a stock option package covering roughly $226 million worth of shares. Impact: on one hand, equity compensation can be dilutive over time. On the other, this signals Tesla views Zhu as critical to executing global operations, including manufacturing efficiency, ramp discipline, and cost control. Markets often reward improved management depth because it reduces execution risk and can support higher valuation multiples. Takeaway: investors should watch Tesla's next proxy filings and compensation disclosures for broader patterns. Is Tesla building a stronger executive layer, or is this a one-off retention move? Story 7. Tesla agrees to mediation in a U.S. agency racism lawsuit. Hook: Tesla is attempting to contain a long-running legal overhang that can weigh on brand, hiring, and potentially costs. Context: employment and workplace culture cases can create headline risk, distract management, and lead to settlements or mandated operational changes. Details: reports including Newsblad indicate Tesla has agreed to mediation in the case, brought by the U.S. Equal Employment Opportunity Commission, which alleges serious and widespread racism. Impact: mediation can reduce uncertainty. Markets dislike open-ended legal risk, especially if it can escalate into punitive outcomes or ongoing compliance obligations. A resolution could remove an overhang, but investors should be aware that settlements can also include operational requirements that carry ongoing costs. Takeaway: the key is whether Tesla can close this out cleanly and prevent repeat claims. For investors, reduced uncertainty is typically positive, even if the settlement itself is not cheap. Before we close, a quick market note. A Taiwan Yahoo market recap referenced Tesla shares down about 0.39% in that session. A reminder that macro and risk sentiment still matter day to day even when company news is mixed. That's it for Tesla Daily News Podcast on Thursday, January 15th, 2026. Today's themes were clear. Tesla's share strength in a tougher incentive landscape, product mix moves like the Model Y 7-seater, serious questions around Cybertruck utilization and management, and legal developments that influence execution risk. For tomorrow, watch for any fresh delivery and pricing data, updates on incentive levels across the industry, and whether Cybertruck inventory and lead times shift. If you rely on Tesla coverage that stays grounded in what moves the stock, subscribe, follow, and come back daily for the update.